What's up everybody, welcome to my channel. My name is Andrei and within the next 10 minutes I will show you that investing in startups is much more profitable with an equal level of risk than investing in stocks. On top of that, I will show you that the exact niche you should look into if you want to invest in startups. So stay tuned. Alright, welcome back to the channel. So, what is a startup? Startup is a private company that is designed to scale very quickly. The key metric is growth. Because of this growth, investor can make 2x, 10x, 100x and even more on their investments. Startup investors are essentially buying a piece of a company with their investment. They are putting down capital in exchange for equity. Investors make a profit from their investments during the liquidity event, such as an IPO or acquisition. There are several stages of investing in startups: pre-seed, seed, stage A, B, C, D, whatever you want, and IPO. I will tell you about the difference in the future videos, so please subscribe and hit the bell icon so you won't miss that episode. For now, all you need to know is the earlier stage you invest, the better ROI you have. But here's the downside. Statistically, 90% of new startups fail. 75% of venture-backed startups fail. So, if you want to invest in startups, your chances to be profitable are close to zero.
But Andrei, you've told us that investing in startups is much more profitable with an equal level of risk compared to investing in stocks.
Yep, and now let me show you the numbers. According to Goldman Sachs, the average stock market return for 10 years is 9.2% for the past 140 years. The S&P 500 has done slightly better than that, with an average annual return of 13.6%. As for startup investing profitability, the Cambridge Associated Venture Capital Index shows an ROI of 19.07% per year since 1996. Despite the 2000 dot-com collapse and 2007-2009 recession. Thomson Reuters reports average annualized returns of more than 30% for the last 3 years. So, average ROI for investment in startups is 2 to 3 times higher than ROI for stocks. Pretty impressive, isn't it? Let's dive into the risks involved in this process. If you are investing in stocks or stock indexes, especially in the long run, the risk to lose your money is close to zero. On top of that, the longer you hold your position on a certain stock, the more profitable your investment becomes. All you need to do is just wait until your investment reaches the desired level of profitability. Now, the tricky part about startups. As I already mentioned before, the majority of startups fail. In fact, to prevent losses, investors put their money in startups using a portfolio scheme. So, let me show you one typical example. Let's assume that we have a portfolio of 10 startups. After 6-8 years of typical investing cycle, we have the following results. 5 startups fail and lose your money. 3 companies exit at roughly break-even level and maybe at some minor percentage in your piggy bank. 1 exits and gives you a decent amount of profit. But 1 of 10 is a superstar that becomes a unicorn and makes bank. So, only 1 of 10 companies in venture and angel investments is a potential unicorn and can make 10x, 30x, 100x and even more to make your entire portfolio profitable. You may say,
the game is not worth the candle. It is next to impossible to find such a good deal.
Okay, let me dive into statistics again. According to Crunchbase, total number of private unicorn companies to date is 632. This number increased steadily from year to year. Even this year, we already have 96 fresh unicorns. Interesting fact, 14 new unicorn companies were created this October. It is more than the total number of unicorns in the entire 2012. Or significantly more than the total number of unicorns in 2004, 2005, 2006, 2007 combined.
So what?
So, As I already mentioned before, the total number of unicorns steadily increases year after year, and global funding level remains roughly the same in 2019 and 2020. The average amount from month to month is around $22 to $24 billion. By the way, according to Statista.com, the total market valuation of unicorns worldwide reached an incredible $2.1 trillion as of January of 2020. It means roughly the same amount of investments fund an increasing number of new startups. In other words, you have higher chances to find your unicorn with your investment in 2020 than, for example, back in 2015. And on top of that, the velocity of becoming a unicorn is increasing. This fact is also increasing your ROI and chances to find your unicorn. 20 years ago, it took on average 10 to 15 years to become a $1 billion company, compared to 6 years in 2018 on average. The top of the list becomes a unicorn in less than 1 year. The most recent example is Hopin, a startup that provides online event software. On November 10, 2020, the startup announced that it has closed a $125 million Series B round of capital. According to Hopin CEO Johnny Boufarhat, the new capital was raised at $2.125 billion valuation, making Hopin a double unicorn. Amazing jump from zero to more than $2 billion valuation in 16 months. You may say,
It's all about the virus and the lockdown.
of course, but it is the best soil to grow your startup. Paradoxically, recessions and unstable periods present the best opportunities to start new company. During the 2008 financial crisis, billion-dollar startups like Uber, Airbnb and many others were founded partially as a response to changing market dynamics. The present day is no exception, offering once-in-a-lifetime opportunities and unfair advantages to potential entrepreneurs. In summary, I just want to say that investing in startups, especially now, could be much more profitable than investing in stocks, but you have to stick to the rules. First of all, invest in bulk of startups. Use the portfolio scheme, otherwise you will lose your money. Then, always do due diligence. Finally, avoid the red flags. What is due diligence and what are the red flags, you may ask? These are the topics of my future videos, so subscribe to my channel, hit the bell icon and you won't miss those episodes. For now, let me dive deep into a new niche you should look into if you want to invest in startups. But first of all, the disclaimer. It is not a personal or financial advice. It is just my opinion based on my own experience and statistical data. Okay, 2020 is a very tough year for all of us. It is also very tough for the majority of businesses, but some of them doing pretty well. Let's focus on the industry that has been the least impacted by COVID-19. I will explain to you my logic right after you hit the like button. Okay, during this pandemic, you can see a huge spike of different delivery services, remote working services, internet courses, etc. But the reason for this kind of growth is the pandemic itself, and there is a high chance of decreasing in revenue right after the COVID outbreak ends. So, if you find the right industry, you will have the highest ROI. Okay, let me reveal the secret of the least impacted by the COVID-19 industry. And the winner is... video game industry. Look at the numbers. From 2001 to 2019, gaming industry shows us consistent growth from $20 billion up to $151.9 billion. According to the latest figures, the video game business is now larger than both the movie and the music industries combined, making it a major industry in entertainment. Even now, more people are playing computer games than ever, with a 46% DAU increase in HD gaming and 17% in mobile gaming. The forecast for the gaming industry for 2020 is $159.3 billion, with 9.3% year-over-year growth. So this is one of the industries you should look into. There you will be able to find your unicorn, and I will do my best to help you. So stay tuned. If you found this information helpful in any way, just make sure to hit the like button for the YouTube algorithm. See you!